Today, we're going to go over how to actually make decisions with your investment and build a strong portfolio. This workshop will last about an hour, and then we'll have a live Q&A for about 30 minutes at the end of the presentation. These workshops are intended to serve as a foundational resource to get you thinking about your finance and not as a final stop in your financial journey. Consider the information and see how you can apply the concepts and cover to your personal financial situations. Also, please understand that while we do our best to answer all related questions, we will not be discussing topics beyond the scope of today's conversation. So if you have any specific questions that we're unable to address, consider setting up an appointment with a financial professional. So we have sent a pre-survey and we hope you have completed, and there'll be a post-survey sent at the end of the session. So if you fill out both, you will be entered into a draw for one of the $450 Tim Hortons gift card. And don't worry, we won't use your email address for any other reason except this draw. So a little bit more about this program. As I said before, this is the Canadian Foundation for Economic Education and National Bank partnered to offer post-secondary education students across the country access to financial literacy workshops. The program, Help Managing Your Money on Campus, is designed to help support young people by providing you with comprehensive financial education modules. This is so important and timely because more than ever, we live in a complex financial world. The majority of you have likely already experienced this world of financial costs, responsibilities, planning, spending, debt, and credit cards, and much more. And that's exactly why we are partnered with the universities and colleges across the country to help equip students with the information you need to take on all of life's financial challenges. So we have asked students what their priorities are in the first half of 2020 and what they want to learn more about. 1,500 surveys later from students all across the country, and this is what we found out. Hopefully, we hope that most have done basics where we introduce why to invest and the types of investment, and this module will go deeper on investment strategies. So the survey findings tells us that 76% of students listed investing money for the future when asked specifically what topics they want more information on. Then 64% of students want to learn how to deal with financial stress, and 55% of students want to build a financial healthy life. We hear your questions and we understand your challenges, and that's why we put together today's presentation. Investing in stocks, bonds, cryptocurrency, and real estate is a great way to expand your financial skills and include additional streams of income. But there's information, terms specifically one needs to be aware of before you're investing your hard-earned money. And that is our primary goal with this webinar, to educate everyone with the information they need so you can make your own choices about your investments. To start off, it's worth mentioning that in the world of investing, there's a lot of jargons, but that's really common for any subject. The medical field is filled with cryptic jargons, terms like acute and negative. Of course, the business world is no stranger to lingo like bang for the buck and due diligence. There are a lot of examples of political jargon, including terms like deep state, and bipartisan. I mention these terms because perhaps you're more familiar with them than you are with investing language. But either way, it speaks to the fact that every subject area has terminology. So today we are going to go over several basic and intermediate terms and teach you their meaning so you can start speaking the language of investing. So today I'll be pulling up a poll to find out how many terms you know from this slide. You can know all of them or most of them, some of them, or none of these terms. I think mentioned some of the terms. That's good to know. I think everyone answered. We'll just end the poll. Okay, it's good that's some of the terms. We'll get more into it. Okay. So today we're going to go over how to actually make decisions with your investment and build a strong portfolio. First, we're going to look at how income taxes can affect our investments and the accounts that can help. Then we're going to talk about investment strategies we can use to reduce our portfolio risk. Finally, we will look at how to actually choose stocks. So let's get into it. So the learning objectives are coming out of this workshop, you will learn how to minimize taxes as you progress in your career and your annual income charges changes. Be much more comfortable managing your investment risk by applying techniques like dollar cost averaging and diversification to your portfolio. Third, being able to analyze and understand the potential long-term value of a common stock of a company you choose to invest in and the important metrics to follow. It is very important to invest efficiently, especially when you're first starting out. You want every dollar you invest to be used to its maximum potential rather than being wasted on taxes or etc. In this section, we will discuss how to invest efficiently to maximize your earnings. When it comes to investment accounts, there are two general types. We will review the difference between registered and non-registered investment accounts. We will talk about the tax implications of non-registered accounts for each of interest income, dividends, and capital gains. Then we'll focus on some specific account types, particularly those that are most important to young people. That is the TFSAs and RRSPs. So TFSAs are great for everyone. If your annual income is less than $50,000 per year, then you should ensure to contribute fully to your TFSA before considering an RRSP. An RRSP is advantageous as you are making more money. In particular, as you move into the second and higher tax brackets, which is over $50,000, then it makes sense to begin to contribute to an RRSP. So there are two types of investment accounts, registered accounts and non-registered accounts. You can think of these investment accounts as containers that can hold all sorts of investment. You could keep cash equivalents, fixed income assets, and also equities, even mutual funds and ETFs in your investment account. A registered account is an investment account that is given tax deferred or tax sheltered status by the government. So what that means is that income earned in the account, like capital gains or dividends, are not taxed until withdrawal or in the case of a TFSA, which is never subject to taxation. In order to ensure that the registered accounts are used for the intended purposes, the government puts rules in the place that must be followed. For example, there's the contribution limits. In this presentation, we'll be covering two of the most applicable registered accounts for young people, RRSPs and TFSAs. But those aren't the only types. Take an RESP, that's a registered education savings plan. A registered account which is meant to help parents save for their children's education. A non-registered account does not enjoy the same tax sheltered status as its registered counterpart. There are general investment accounts where you can invest in a wide range of assets and are required to pay taxes annually on income generated by the account. Investors appreciate non-registered accounts flexibility as they do not have any contribution or withdrawal limits. A common type of non-registered brokerage account is cash account. Cash accounts are investment accounts in which income is taxable in the year earned if there are any capital gains, dividends, or interest income. If you have already maxed out your registered accounts, TFSA and possibly RSP, depending on your income, A non-registered account allows you to continue investing. A general rule of thumb is that if your annual taxable income is less than $50,000 per year, a TFSA makes a lot of sense, but it likely doesn't make as much sense to contribute to an RRSP. And a non-registered account might make more sense once you fully contributed to your TFSA. Non-registered accounts are Canadian investment accounts, which can be taxed. As a rule of thumb, you can expect any form of earnings in this account to be taxed. So 50% of your capital gains are taxed in non-registered account. The tax rate depends on your personal tax bracket. If you're in the highest tax bracket in Ontario, you would thus pay 27% on capital gains. 100% of the interest you earn in a non-registered account is taxed. Once again, this tax rate will vary based on your personal tax bracket. If you're in the highest tax bracket in Ontario, you would pay 54% tax on interest income. When it comes to dividend earnings in a non-registered account, you will be taxed based on your personal tax bracket. Qualified Canadian dividends are eligible for a 15% federal dividend tax credit plus a provincial tax credit. In Ontario, that is an additional 10% tax credit, which will cut your effective tax rate. If you have less than $50,000 in an annual taxable income, you may actually be charged a negative tax rate on dividends due to these tax credits in Ontario and BC. For Quebec and Alta, you will pay 5% tax on qualified Canadian dividends if you're in the lowest marginal tax. Investors in the highest tax bracket in Ontario pay tax of 39% on dividends compared to about 54% on interest income and 27% on capital gains. As you can see, a non-registered account have some unique tax consequences. If you're investing in dividend-paying stocks and are in the lowest tax bracket, then it can make some sense to have some money in a non-registered account to take advantage of the negative tax rate. Now, let's take a deeper look into just how effective registered accounts can be at saving your money. So a good investment vehicle for many young people are tax-free savings account or TFSAs. You can use a TFSA for any savings goal, short-term or long-term. Many people like to describe a TFSA as a storage container, and you store all kinds of stuff in it. For example, you can put cash, GICs, bonds, stocks, mutual funds, and also ETFs. And the best part is that all those investments grow tax-free inside the TFSA. Simply what that means is that you won't have to pay any capital gains taxes or income taxes on your investments growth. This can really make a difference over time. Remember the magic of compounding. Finally, as an added bonus, you also won't pay any tax on the withdrawals from your TFSA, so you can move money in and out of the tax without any tax consequences, as long as you follow the rules. If you take money out of the TFSA, you cannot replace it until the following year. Now, there are contribution limits up to a maximum amount each year, for example, $6,000 in 2022. Otherwise, everyone would put all the investment in a TFSA. And it's a great deal. Here's some good news. Let's say you can't make a full $6,000 contribution in 2022. You can put in the difference plus following year's limit next year. That's because the contribution limit is cumulative, and so unused contribution room rolls over from one year to the next. You can find out how much contribution room you have in your TFSA by making a CRA My Account. For Canadian residents who were 18 when TFSAs were introduced, in 2008, You could put 81,500 into one right now if you haven't made any contributions yet. The other notable investment account for young people is Registered Retirement Savings Plan, or RRSP, which is meant to help your investments grow and again tax-free like a TFSA until you're ready to retire, and offers other tax advantages too. Investments that can be held in an RRSP are called qualified investments. They include cash, GICs, bonds, including government bonds, corporate bonds, mutual funds, only RRSP eligible ones, ETFs and equities, which is both Canadian and foreign stocks. By using an RRSP, you get immediate tax relief by deducting your RRSP contributions from your income each year. You don't get that tax deduction with TFSA. Effectively, with an RRSP, your contributions are made with pre-tax dollars. The money you make on your RRSP investments is not taxed as long as it stays in the plan or in the account. You'll pay tax on your RRSP savings when you withdraw them from the plan. That includes both your investment earnings and your contribution. But you have deferred this tax liability to the future when it's possible that your marginal tax rate will be lower in retirement than it was during your contributing years. The intent of an RRSP is to be a plan where you put your money once you're earning enough to enter a higher tax bracket. By putting it in your RRSP when your taxes are high, you're able to decrease the amount you have to pay. The benefit of this becomes pronounced if you then leave the money in your account to compound until retirement, when your taxable income should be far lower than your prime working days. The income you may have paid 33 to 43% marginal tax on earlier in life may only be taxed at 20% depending on your post-retirement income. So that's as much as 23% tax savings. Or if you're in the highest tax bracket, that's 33% on your tax burden. When combined with compound interest, RRSP can be a great investment strategy once you are in a higher tax bracket. Your RRSP contribution room accumulates each year too, based on your annual taxable income. So for 2022, it was the maximum contribution is 29,210, or 18% of your earned income less your pension adjustment. This chart highlights a few important distinctions between investment accounts. While they are both storage containers, to use a popular illustration, meaning you can put investment in them, you should note some important distinctions. A TFSA can be contributed to without any income, whereas you can only place a percentage of earned income into an RRSP. That's 18% up to an annual limit. Contribution to a TFSA are not tax deductible, whereas contributions into an RRSP are. You can withdraw from TFSA without paying any taxes on the withdrawn amount, unlike an RRSP. If you do not use your annual contribution room in either TFSA and RRSP, once eligible for either, it accumulates. Also, it's worth pointing out that you can continue to use a TFSA for tax-free savings, tax-free investment growth your entire life, whereas money in an RRSP must be transferred to a different type of account after age 71. After all, it is meant for retirement. So the key takeaways from this section will include everyone should have a TFSA. Well, pretty much. There's quite a bit to know about TFSA, but they're generally a good investment for young people to have. Look into TFSA and ask about them and see if they would work for you. Second, taxes can eat away at your returns, so it is important to use investment accounts to your advantage. Recall the tax implications associated with non-registered accounts. They can both help if you're a dividend investor in the lowest tax bracket, and also really add to your cost over time as you are making more money. Ultimately, it's what you keep that matters. So when you are considering investing, be aware of the investment account options available to you and take advantage of those tax benefits. Make sure you adapt to the investing approach that is the most tax efficient as your earnings change. Maximize the value from the Canadian tax rules and can be very beneficial to your long-term results. Now, let's cover some investment strategies you can use to reduce your risk. Today, we will be reviewing the following strategies to reduce your risk while investing. So the first is diversification. We will also watch a quick video which will solidify the information we covered today on diversification. Second, asset allocation. Natural extension of diversification and something to keep in mind as asset allocation has been proven to drive 80 to 90+% of a portfolio's return over time. Third is dollar cost averaging, simple strategy to make a regular investment of a fixed amount in an asset. So let's begin with a quick video about diversification. I hope everyone can hear it.
When you invest in a stock, you're taking a risk that the value may go down rather than up. Okay, we get it. Investing can be risky. One way to manage that risk is to learn about asset allocation and diversification. Asset allocation is financial lingo for how you distribute your money across types of investments, like the strategic decision of which baskets to put your eggs in and how many. The different baskets are called asset classes. To help you decide where to put your eggs, ask yourself, how much time do you have before you need to use your money? How comfortable are you with risk? And how does your current financial situation look? Diversification is about strategically putting the right mix of different eggs in each of your baskets. The key is that you shouldn't invest all your money in one company, one industry, one country, one anything. Ideally, you want your investments to be negatively correlated, so when one is going down, another is going up. Here are some typical ways to diversify your portfolio. Invest in companies in different countries. Own stock in small and large companies, and invest in companies in a variety of industries. One downside to diversification is if one of your investments does very well, you won't make as much as if it was your only investment. Conversely, if you owned only one stock and the company went out of business, you would lose more money than if you had diversified your money. Diversification won't eliminate risk, but it's a smart way to manage risk while allowing you to build your portfolio.
Okay, so the main takeaway from this video is to remember not to put all your eggs into one basket. So meaning that do not put all of your money into one investment. So by diversifying your investment, you're expanding your investment portfolio. So you're also not reliant on just one to two investments. For example, let's say one of your stock investment is down for a week or for a few weeks or more. By diversifying your portfolio, you will reduce the risk of a loss from your investment. So a common way to mitigate or reduce risk is to diversify your investments. And this can be achieved in a variety of ways. So in a nutshell, diversification means not putting all your eggs in one basket. You will want to have a good mix of different kinds of investments. Why? Because that provides you with some protection. If some of your investment fall in value, others may rise. If some are quite volatile, others may be pretty stable. By diversifying your portfolio, you lower your risk. You will not eliminate it, but you can reduce it. One of the primary rules of investing is to diversify. So in real estate, it's location, location, location. In investing, it's diversify, diversify, diversify. Mutual funds and ETFs provide instant diversification just from their structure. ETFs are as the name suggests, exchange-traded funds traded on exchange, just as common stocks do. At the other side of the trade is some other investors like you, not the fund manager. Mutual funds are when you put all your money into mutual fund. The transaction is with the company that manages it, either directly or through a brokerage firm. The purchase of a mutual fund is executed at the net asset value of the fund based on its price when the market closes that day or the next day if you place your order after the close of the markets. Both mutual funds and ETFs hold portfolios of stocks or bonds and occasionally something more exotic, such as precious metals or commodities. Whether you invest, whether it be today or in the future, you can diversify in terms of the type of investment you make, like stocks, bonds, GICs, etc. Also, you can diversify in terms of the level of risk of investments. Different examples of diversification is broadest, investing basics talked about cash type plus fixed income equities. And there's first level of diversification, diversify major asset classes. Then you can get into specific like industry or geographics. Powerful tool, and you should get single investments like GameStop. Diversify can be the only free lunch or like paid on what the risk you're taking. Diversify risk, take different risk and different moving parts. So last year we did during the investing basic webinar, the different assets we covered were cash, fixed income, equities, mutual funds, and exchange traded ETFs. These can be great tools used to diversify your portfolio. We also mentioned the different levels of diversification. Whether you invest today or in the future, you can diversify in terms of the type of investment you make. Stocks, bonds, and GICs, etc. You can diversify in terms of locations of your investment, for example, in Canada, the US, Asia, etc. Also, you can diversify in terms of the level of risk of your investment. There are also a number of diversification strategies that you can adopt. Let's look at a couple. We'll look at asset allocation first and then dollar cost averaging. First, let's check out asset allocation as a diversification strategy. Asset allocation looks to build an investment portfolio with set of proportions of different assets based on an individual's goal. For the long-term investors, the asset allocation decisions will be key determinant of the return of the portfolio over time. Each investor's goals are in part a product of their age, risk tolerance, and investment horizon. Remember the three asset types we discussed in a previous workshop? Equities, fixed income, and cash equivalents. Asset allocation seeks to build a portfolio made up of set percentage amounts of the various asset types. For example, a more aggressive investor might opt to build a portfolio of 80% stocks and 20% bonds, whereas a more conservative investor might opt for a portfolio of 40% stocks and 60% bonds. From the paper by Roger on the true impact of asset allocation on returns, in the summary is that the impact of asset allocation on returns depends on an individual's investing styles. So for the long-term passive investor, the asset allocation decision is far by the most important. For short-term investors who trades more frequently, invest in individual securities and practices market timing, asset allocation has less of an impact on returns. So the impact of asset allocation on performance is directly correlated with investment styles. So either way, at the end of each year, asset would be bought and sold to rebalance the portfolio to your risk tolerance and to ensure a constant portfolio asset allocation, hence the name. A key determinant of how to invest is the time horizon of when you need the money. Please don't invest money you don't need for tuition or rent in the coming months for quarters into the stock market. The idea of this table is that As you continue your time horizon, as the time as your time horizon becomes longer, you can withstand the ups and downs of the stock market more so. The key is to hold for longer term, presuming nothing fundamental has changed in your investing rationale, and not panic and sell as the market takes its typical drop every few years. This slide shows various asset classes and their relative position each year, as well as portfolio following asset allocation principles that contains a combination of the other classes and is balanced each year. Past performance is a poor indicator of future results. In 2017, global bonds were the worst and best in 2018, and one of the worst again in 2019. And that is only one of many examples of variation in asset classes over the 10 years. Trying to predict the market by looking at past performance may pay off at times, but it's a poor strategy for the long run. Now on to the third and final risk management strategy. That's the dollar cost averaging. Dollar cost averaging, another powerful diversification strategy which involves regular investment of a fixed amount in an asset. Take any stock as an example, rather than trying to time the market, which has been shown to be quite effective. Dollar cost averaging suggests you ignore the price fluctuations of your investments and continue with regular and constant purchases. That means buying stock through the good times and the bad. This is risk reduction strategy is particularly applicable in the long run. Or over a long period of time. By buying more at irregular prices and buying less at higher prices, which will average out your cost. That's because by continually buying a stock over time, not only do you increase your portfolio, never forget about compound interest. You're also able to maintain an average purchasing price that is fairly close to the market price, meaning that your portfolio's value should be more stable and less volatile. So an example would be to put $100 a month into stock index over the course of 5 years. Course of 5 years. At times, the stock index price might be $10 per share, which means you buy 10 shares. Okay. At the times, the stock index price might be $10 per share, which means you buy 10 shares. And at times, the stock index might be priced at $5 a share. So you would put your normal $100 into the stock index and buy 20 shares. So over time, you're averaging out the prices of the stock by buying a set amount each month. Here's the table to show how dollar cost averaging can work. You invest $100 a quarter into a stock throughout the year. Then the price of the stock goes up and it goes down, but you keep buying $100 worth of the stock. At the end of the year, your investment is worth $430, a roughly 7% increase over the $400 you have invested. Note that the stock price is back to $10, exactly where it started the year. This value creation is mainly due to the discipline of dollar cost averaging. A tweak on dollar cost averaging can be to invest twice as much, in this example of $200. If the stock price drops more than, say, 20% since the beginning of the year, for the table above, that means you would have invested $200 in April and bought roughly 25 shares. Now let's look at this dollar cost averaging example. What would happen if you continuously put money into the S&P 500 on a monthly basis over the course of 5 years? Well, in this example, all the investment you made would end up profitable. In particular, the investment you made during the dips would be doing really well. Let's keep in mind that this chart accounts for the stock market activity during the pandemic. So even with the pandemic occurring, all your investments are still profitable in this scenario. So your key takeaways from this section would be diversify your portfolio to minimize risk. Your asset allocation depends on your goals, age, and risk tolerance. Consider buying different types of assets from different countries and different sections. Dollar cost averaging is a great strategy for the long run. And the last thing for this section would be diversification is an important factor when investing because putting all your money into one stock is like buying a lottery ticket. You should not make it into an investing strategy. Now we are on to our final section, which is how to choose stocks for investing. Deciding which stocks to purchase can be a complicated and tedious process. Let's go over some of the steps you should take when deciding which stocks to buy. In this section, we'll be covering where you can purchase stocks from, what to look at when purchasing a stock, and what to consider when investing in the stock market. So where you can go to purchase stocks? Well, firstly, stocks must be purchased through a licensed broker. You may sign up with a direct brokerage to purchase stocks. For example, there's National Bank Direct, Bank Direct Brokerage, then there's Wealthsimple, and then there's Questrade. Stock commissions will vary between $0 and $9.99 per trade. ETF's fees are usually less than 0.25% per year. Second, a robo-advisor is a blend of advice and no advice, where a broker will tailor a portfolio, usually of exchange-traded funds, based on your risk profile. Fees for robo-advisors will tend to be in between buying stocks directly and a full-service dealer. Robos will charge 25% to a 5%, 0.5% in addition to the ETF's fees. You can buy stocks through a full service dealer. The National Bank has one as well as all the other banks, but they're also independent as well, like Raymond James, Edward Jones, and Astain. Fees will typically be 2 to 2.25% for purchasing mutual funds through a full service dealer. Keep in mind that every brokerage and licensed dealer has different fee structures and benefits. For instance, full service brokerage offer professional investing advice, but this may come at a higher cost than alternative options. Make sure you do your research in order to find out which option works best for you. So there are 4 main factors to consider when buying a stock: company size, industry sectors, geography, and beliefs. Let's take a closer look at them one by one. Company size is a factor when deciding which stock to purchase. Market capitalization, or market cap, shows a company's value based on the stock market. The market cap can be calculated with the following formula. That's the value stock into outstanding shares. In Coca-Cola's case, the market cap stands at $260 billion. As of June 17, 2020, when Coca-Cola stock was at $59.74. So based on company's market cap size, they can be categorized into one of the following cap sizes. So micro cap is between $50 million to $300 million. Small cap is $300 million to $2 billion. Mid cap is $2 billion to $10 billion. And large cap is $10 billion plus. Now to quickly test your knowledge, Air Canada has a market cap of $8.6 billion. At April 20, March/2022, their Air Canada common stock was at 2024. So which category would this market cap fall under? If you like to put your answer in the chat, Air Canada has a market cap of $8.6 billion. So which category would this market cap fall under? If you like to put your answer in the chat, I'll just wait a few seconds. Okay, yeah, you put mid. Yeah, that's the correct answer. Correct answer is in the mid cap since it's 8.6, like it's between $2 billion to $10 billion. An extra tip is that if you wanted to diversify in this scenario, you would want to put your portfolio to consist of different sized companies. Industry sectors also play an important role in deciding which stocks to purchase. Each company listed on the stock market falls within a certain industry sector. So in some instances, the sector a stock is in can have varying effects on the performance of the stock itself. So here are some well-known industry sectors. That's materials, financials, healthcare, energy, and information technology. Let's look at just how a stock can be affected by its industry sector. For instance, political pressure on non-clean energy can have significant impacts on the stock performance of oil and gas companies within the energy sectors. Geography also plays an important role in deciding which stocks to pick. Based on companies' location, they are subject to different opportunities and risk. And this is often based on the location's economic, social, and political situations. A company located in a region experiencing heavy political turmoil is most likely not the safest investment. Economic, political, and social situations are always changing in different regions, and it's important to stay up to date. Another important but often overlooked factor is your own beliefs and products you purchase. This is when you choose to invest in a company that you use or strongly believe in. Your personal connection with the company gives you better perspective of the value the company provides to its consumers. So if the financial and other variables make sense, this may be a viable option when deciding which stock to purchase. What's a growth stock and what's value stock? What's the difference between these two? So a growth stocks are companies that are believed to outperform the market over time because of their perceived future potential. Growth stocks may have fundamentally expansive projects, be a leader in a new industry, aggressive forecasting of the future. An example would be Amazon or Tesla. A value stock are companies which are trading below their true value. As a result, these stocks boast can be great value if the reason for the stock being cheap is not related to the fundamentals of the businesses. So if the business they are in isn't fundamentally challenged, for example, think blockbuster movie rentals a decade ago, then the stock may be cheap for a very good reason. Value stocks can provide a greater return than the market average over time. Examples of value stocks will change over time, and so try to find. So now let's look into debt to equity ratio. Debt to equity ratio is used to determine a company's financial leverage. To put it simply, this calculation checks to see if a company is using their own money or debt to fund their operations, and to what degree. The debt to equity ratio is calculated by dividing a company's total liabilities by its shareholders' equity. So lower debt to equity ratio means company is operating with their own funds rather than incurring debt to fund their operations. And a higher debt to equity ratio means company is incurring debt to finance their operations. And it could potentially be a higher risk investment, which can pay off well if the company can invest the debt profitably. But excess leverage may also be a death kennel for a company if they can't make the payments on their outstanding debt. Now let's take a video providing a deeper explanation of this.
The debt-to-equity ratio is a measure of a company's financial leverage. Al and Ed both go to the bank for business loans. The loan officer looks at their respective balance sheets. Ed has $120,000 in assets, cash, equipment, and so on. Ed also has $100,000 in liabilities, mostly loans. So Ed's equity is $20,000. The loan officer divides Ed's liabilities by his equity to come up with a ratio of 5. This means Ed has $5 of debt for every $1 of equity. Ed is highly leveraged, so he's a high risk for the bank. His application is declined. Al's balance sheet is much stronger. Al has $150,000 in assets and only $50,000 in liabilities. His equity is $100,000. Al's debt-to-equity ratio is 0.5, $50,000 over $100,000. This means Al has 50 cents of debt for every dollar of equity. Al's low debt-to-equity ratio makes him a low risk for the bank. His application is approved. The debt-to-equity ratio identifies companies that are highly leveraged and therefore higher risk. But no single ratio can tell the whole story.
Companies taking on a lot of debt may not perform as well as that company that has less, and this is an indicator of risk. Apple is a good example. In the beginning, there was a lot of risk with the company. So by taking on debt, they would not be able to service the debt. But now Apple is making much more money. They can afford the debt. This will increase the broad return for the shareholders. Let's take a look at few factors when Let's take a look at few more factors to consider when deciding which stock to purchase. Firstly, the price to earnings ratio can be potentially used to determine if company stock price is undervalued or overvalued. Keep in mind that this isn't a definite calculation in terms of telling you to buy a stock or not. Low or high price to earnings ratios aren't inherently good or bad. The price to earnings ratios can be calculated by dividing a company's current share price by its earning per share. For example, Apple has current annual earnings of $6 per share and a stock price of $165. And so the price to earnings ratio is 28 times. Lower price to earnings ratio might mean the company is undervalued or investors may be losing confidence in the company. A higher price to earnings ratio might mean the company is overvalued or investors might be expecting large growth in the future. It is very important to look at the price, so to a price to earnings ratio within an industry sector. Recall earlier slide, we talked about materials, financials, healthcare, energy, and information technology. As different industries will trade at different price to earnings ratio due to differences in inherent profitability, profit margins, growth versus value, etc. It's also look at historical price to earnings ratio of the company as another way to judge current value. If a company has a lot of cash on hand, then price to earnings, it might not make as much sense. If a company's market is $200 and then cash is $50, then look at price to earnings ratio using $150 assets, the $150 that's generating the earnings. For example, if a company earning is $10 per year and then the market valuation is $200, it looks like it's trading at 20 times price to earnings, which might look expensive. When you remove the $50 of cash, then the stock is trading at 15 price to earnings, which might mean it's cheap. At the end of the day, what the shareholders cares about is how much cash a company can generate from the business. This is referred to as cash flow from operations and can be a much better metric than price to earnings. You may want to deduct capital expenditure from cash flow from operations if a company is spending a lot of money on new machines, etc., to generate cash flow from operations. A company that is growing a lot and hence has to amortize into income and expense for goodwill, amortizations each year might show negative accounting earnings. But if the company is generating $10 per year in cash, and that is the money that can be used to expand operations, pay dividends, and acquire new companies to continue growing. We won't get too deep into the weeds, but one module to value companies is to look at the dividend discount model. The dividend discount model is a good way to decide how much it's worth spending right now per share of a company. Based on the dividend it will pay, the expected growth, and the overall risk of the company. It is meant to take all of the cash flows you expect from the company, so the annual dividend plus a terminal value of the company way out in the future, and discount them back to today. You will discount the cash flows you expect at a rate of interest to reflect the riskiness of the company. The riskier the company, the less you will value it today. This is because your chances at actually getting a return are lower with the riskier company. You will also adjust for the fact that the company is expected to grow its cash flows to the shareholders over time. So if you calculated your price, is the highest price worth paying based on the anticipated future value of the company? If the price of the company is lower than the current share price, then the shares are too expensive for the anticipated return. If the price of the company is higher than the share price, that means the shares are selling for less than your max price and may be worth purchasing if their other financials are also strong. Cost of equity is driven by the risk-free rate, example, government bonds, plus the risk premium demanded by the market due to the riskiness of the company. Riskier companies such as new technology companies would likely have a higher cost of equity. Mature companies have less growth prospects and so lower growth. New innovative companies would be expected to have a very high growth rate. Lots of assumptions go into the above calculations, and hence why people are willing to buy and sell stocks at a very different price. It is important for you to determine what you think fair value is for a company's stock to ensure you aren't overpaying for the stock, and also so that you don't keep holding it when it's well past your estimate of the fair value. As you can see, there's a lot that goes into picking a stock. In fact, there are plenty of more complex strategies used to determine which stocks to pick, which we won't cover in this workshop. There are professionals who do this full-time, are known as portfolio managers. They usually have their own chartered financial analyst designation, which is a series of 3 exams that will likely take you 3+ years to complete. The CFA program is 3-part exam that tests the fundamentals of investment tools, valuing assets, portfolio management, and wealth planning. Then there's Canadian Securities course, and this is a baseline course to allow you to perform securities transactions for financial institutions. It is a self-learning course that will give you a solid understanding of the Canadian financial service landscapes, ethics, and knowledge of equities and structured products. derivatives, and many more items. This has one exam, and you will probably take 3 to 6 months to complete it. And there'll be a Zoom poll now. That's just a quick test your knowledge. So the question is, which of these is not a factor of deciding which stock to buy? Industry sector, friend recommendation to purchase, company, or geography? The question was, which of these is not a deciding factor of which stock to buy? It's not geography. It is answer is friend recommended to purchase. So the thing is, don't base your investment on what your friends tell you. It's important to do your own research. So the key takeaway is that it's understanding the fees associated with purchasing and selling stocks is important. There's a lot that goes into choosing a stock. Developing your judgment, you can develop your judgment, and then you can also reach out to professionals. So let's review what we learned very quickly. We learned 3 important sections and subsections in each one. So in this first section, we covered importance of diversification, and then the follow-up strategies which can be used to diversify your portfolio. So if you may recall, they were asset allocation and dollar cost averaging. The second, we discussed the process of buying stocks and the different factors you must take into consideration and further research when purchasing stocks. And in the third and final section, we discussed 3 alternative options to investments, what they were, how to make money, where to buy, and the risk associated with it. These alternate investments were cryptocurrency, precious metals, and real estates. So in this summary, investing tax efficiently is everybody, all the young people should have a TFSA. And second was taxes can eat away at your return. So it's important to use the investment accounts to your advantage. And then third, make sure to adopt to the investing approaches that is the most tax efficient as your earnings change. Investing strategies is diversify your portfolio to minimize risk. Your asset allocation depends on your goals, age, and risk tolerance. Consider buying different types of assets from different countries and different sectors. And the third is dollar cost averaging is a great strategy for the long run. How to choose stocks, understand the fees associated with purchasing and selling stock. There's a lot that goes into choosing a stock. And last but not least, develop your judgment. And you can also reach out to your professionals. So coming out of this workshop, you will learn how to minimize taxes as you progress in your career and your annual income changes. Be much more comfortable managing your investment risk by applying techniques like dollar cost averaging and diversification to your portfolio. And third, being able to analyze and understand the potential long-term value of a common stock of a company and you choose to invest in and the important metrics to follow. As we discussed, these are some of the key steps of action to evaluating and making investments. This slide's detailed information, which we have covered, will help you take action right away. First is to do your own research. Pick a company where you like their products and try to understand the value of the company and how the stock price has moved around. Ensure you have calculated the relevant ratios, observe the stock's performance or investment's return, and overall familiarize yourself with complexities. You should begin by setting up a practice account at a discount broker. By using a practice account, you can become aware with the fluctuation patterns of investments. Talk to a financial advisor about investing. Check out more program resources. Be on the lookout for additional program resources which can help you develop better judgments and help increase your investment returns. And also, we'll be sending out, at the end of the presentation, we'll be sending out a resources. So hope you check that out. So final tips are learning about risk reduction strategies such as diversification and asset allocation. Second, it takes time to develop your judgments. And third, thoroughly understand the risk associated with each investment types before investing. So now this brings to our formal presentation to an end. Thank you all for listening patiently. And right now, if you have any question and answer, we'll answer any questions. Before that, we have sent out a pre-survey and we hope you've completed. And there'll be also a post-survey sent, which has been sent at the end of the session. So if you fill out both, you'll be entered into a draw for one of four $50 Tim Hortons gift cards. And we won't be using your email for any reason except the straw. If you have any, I'm just going to stop sharing. If you have any questions, please feel free to ask.
Oh, I think we have a hand up.
Oh, yes. Michelle?
Yeah, I was just wondering for students, I've heard traditionally RRSPs have been for retirement, but I've heard of young people using them for more immediate reasons now, like for down payments for their house, or for example, I've heard of a lot of young women have started using them because maternity leave can be 18 months now. So they'll take it out in the 6 months where they're earning no income on that leave. Do you have any thoughts or advice for young people on using RRSPs for reasons sooner than retirement?
I think Chad has an answer
Yeah.
to that.
Yeah, sure. First thing would be definitely make sure that you are getting an RRSP that you can withdraw from early without penalties. There will be there's a certain type of RRSP that you can set up that restricts your ability to take out the funds early, or it charges you a penalty if you do. If you're planning on taking it out before retirement, that's definitely not the type of account you would want. If that's what you're hoping to do, like especially the maternity leave pay, things like that, that can definitely negate the potential downside of putting it in when you're in a lower tax bracket, because you would still be in a lower tax bracket during your maternity leave time, because that's the point, is you're trying to supplement that income a little bit. So that would definitely be a good strategy to kind of spread your income from pre-mat leave to during mat leave. It decreases what you're making right now, but it gives you that extra relief during that time and lets you take off that extra, couple months, maybe a year, depending on how much you would normally take off. It is also, as you mentioned, the home buyers plan. It's available. You can withdraw up to $35,000 from your RRSP to use as a down payment. This is awesome that it's available, because you end up using the kind of pre-tax money for your down payment. You just have to make sure that you're able to put it back in within that time, within a certain time frame. I think it's 35 years. No, it's 15 years. You have to put it back in within 15 years, or you then add it to your income. There is actually a new program that is being added this year called the First Time Homebuyers Savings Account, the FHSA. It has the same kind of features as an RRSP, where when you put money into that account, it is a tax deduction. But on the back end, it's like a TFSA, where when you use it for a down payment for a house, you don't have to pay taxes on it and you don't have to pay it back. So it's actually just makes it so if you're putting money into that account and you use it for a down payment on a house, it's pre-tax money, and you never have to worry about lowering your income later on to accommodate for that. And if you don't end up using it to buy a house within the certain time frame it allows, then you're able to transfer it into your RRSP. So the FHSA is definitely a good account for anybody that's thinking about opening a house or buying a house within the next little while. It's about $8,000 a year that you can put in at the moment. It is not available yet, though. They anticipate around April, kind of for the new tax period, you'll be able to start putting money into that. So hopefully that was a nice long answer to your question.
Thanks.
Thank you so much, everyone. It was so informative session, and I learned a lot about the investment. Thank you so much.
Thank you for coming.
Awesome. So if we don't have any other questions, then we can call it there. So thank you very much for joining us. Thank you, Eileen, for the presentation. We hope to see you back here in a couple weeks for our next workshop. What do we have? That will be the investing in alternative asset classes. So we're taking investments a little bit further into some alternatives and some other ways to start building up that diversity in your portfolio. Awesome.
Thank you all. Good night.
Thank you.
Have a
You
great
were
night,
talking
everybody.
about some resources, I think, that you will share at the end of the webinar.
Yes. Michelle, are you sending out a follow-up email with the resource document?
I can, yeah. I've already got her email. So
Thank you so much. Thank you so much, Michelle. Thank you.
no problem. If you could send that to me, Chad and Eileen, then I'll forward it on.
Yep, can do.
Thank you.
Thanks.
Any other questions before we call it?
Thank you.
No problem. All right. Thanks, everyone. Take care.
Good night.